You can see on my chart here, the strategy I like to use on these gap down stocks is to wait. This trading strategy works really well in the fear-driven market environment right now. However, you need to understand these two key factors. In the current fearful market conditions right now, with all the surprise headlines popping up every other day, I'm sure we've all seen these kind of nasty overnight gap downs and overnight gap ups. In this video, I'll be sharing the trading strategy that I've been personally using on these overnight gaps, whether it's an optimistic gap up to the moon or a gnarly gap down back down to earth, which we all seen way too often this year. So we gotta learn how to profit from this strategy. With these overnight gap downs, many traders who are still new and inexperienced would simply say,
"Forget it, I'd rather go work at McDonald's instead."
But the more experienced traders will be able to tell the difference between these stocks and still able to profit from other people's emotions in the market. And they'll still hit up McDonald's after the market close anyways. These trading strategy videos do take me a long time to make. So if you enjoy this content and want to learn more, please make sure to watch until the very end for my step-by-step tutorial on this strategy. And don't forget to smash the like button. I really appreciate it. Alright, there are two key factors to this gap trading strategy. The first one is based on short-term technical analysis, and that is whether we see a gap up or a gap down overnight.
Alright, for those who are not familiar with this term, an overnight gap refers to a drastic increase or decrease of the stock's trading price during the pre-market sessions, compared to the previous day's closing price.
Let's look at this example here, DoorDash stock. You can see in the previous day's closing price on this day, the stock closed around $75 up here. Now the next morning, overnight, you can see the stock gap down all the way down to around $69, $68 pre-market. So that means the stock has sold off, gapping down 10% overnight. Generally speaking, a technical gap down like this one is not enough to indicate whether the stock going to rally higher or going down lower. But in this specific case on Dash stock, this is still a valid short strategy, and we're going to explain why later on. Now that we understand what's a technical gap down, it should be very easy to understand what a gap up is. Looking at the stock TDOC, TDOC, aka one of the many bag holding positions, disruptive investments at ARK Invest. You can see in this example, TDOC, the previous day's closing price was over here, around $38.70. Now the next morning, the stock had gapped up pre-market to around $40.40. That's almost a $2 per share overnight gap up or a 5% gap. As you can see, this setup overnight is very different from our previous example of a gap down on Dash stock. So for TDOC, this overnight gap up, even though it's purely technical, in the current market environment, this does set up for a nice short for this gap trading strategy. So on this TDOC specifically, I was looking at the $40 to $41 area for short entries and looking for it to break down some pre-market support and eventually to gap fill all the way down to prior day's close when it came from at $38.70. I personally messed up on this trade. As you can see here on the chart, I was right on the short thesis for this gap up strategy. However, just off on the timing. And unfortunately, I couldn't hold on long enough to see the stock eventually break down. But this strategy thesis was correct. You can see I traded the same strategy on all of these stocks in the past before, such as DWAC, Nvidia, and AMD. Now you must be wondering,
but Shay, this is not what you said last year. Last year, many gap ups that broke out higher, a good longs, and all the stocks went to the moon.
Well, it's now 2022, and the market is ever changing. The sentiment is much different now. Unless you want to end up working at McDonald's, stop buying breakouts. Nothing wrong with McDonald's, by the way. I still love the Oreo McFlurries and fries. Yes, at the same time. And no, I'm not sponsored by McDonald's, which is why I have to ask you to smash the like button. And I promise you I'll share. Now pay attention, my fellow humble traders, as we're about to dive into the current market outlook and trader psychology. I think it's very crucial that we understand the why or the psychology behind these huge gap ups or gap downs, especially if you're trading short term in a current market environment. Almost all the big moves this year are driven by one thing and one thing only: fear. The fear of oil prices spiking, the fear of negative economic data, and the fear of inflation, and the list just goes on and on. Fear is a much stronger emotion than confidence or optimism. That's the reason the bulls take the stairs and the bears take the windows. There isn't a lot of confidence in the market, and that's why with a lot of breakouts and overnight gap ups, you'll see stocks sell off more often than not. I've been thinking of posting regular market updates on all my social media accounts so I can share my thoughts on the market with you guys. So please comment market update down below if you would like to see them. Let me know in the comment section below and make sure to refer to the description for my real social media accounts. So earlier we talked about the first factor of this strategy, and it was the technical gap up or gap down. The second factor to the strategy is whether there is negative or positive catalyst. Let me explain. As I've talked about in the recent trading recap videos, there are large cap stocks that make overnight moves with their own company catalyst. It could be earnings, potential deal going through, or the newest drama involving Elon Musk. For example, GameStop stock gapped up and moved higher overnight after announcing they are doing a 4-to-1 forward split. Or DoorDash, in our earlier example, gapped down because of negative news that Amazon is making a move into their market. And guess what? No one dares to fight Amazon, especially after seeing Jeff Bezos' badass outfit on a yacht over here. On the other hand, there are stocks that do not have their own company-specific news. For example, the TDOC overnight gap up we saw earlier, it was gapping up to what we call air. Basically, the company did not have strong catalyst to support this overnight gap up. It's a contributing factor to the short thesis on this gap trading strategy. Take a look at another example here, Uber. As you can see here, the stock gapped down overnight due to the same catalyst as Dash. Amazon takes a stake on Grubhub and extends the food delivery service to their Prime membership. This move from Amazon would directly steal market shares from companies like Uber and DoorDash, who are operating in the same food delivery space. Therefore, this Uber stock reacted negatively with a gap down. Prior day's close was around $22.30. Pre-market, it sold off into about $21.80. You can see on my chart here, the strategy I like to use on these gap down stocks is to wait for the bounce in order to short into it with a better risk reward. So on this Uber stock, even though pre-market is trading at $21.80, I waited until the spike to test $22, and ideally I was actually waiting for higher, around 22.20s to short into it. And my price target will be the pre-market support around 21.70s and the lows of the day around 21.40s, eventually probably to $21. It's very important that you wait for the bounce for the right risk reward to short into it. Don't be that person who shorts the stocks like these on weakness at pre-market support or lows of the day. Sure, maybe that might work once a while, but in the long run, that's a very high risk entry. I will repeat. Don't short it at the bottom over here. Wait for the bounce and then write it down and collect your profits. Here are a few key takeaways to remember about this gap trading strategy, especially on the short side. The higher the overnight gap up is, the more likely it is to sell off. The lower the overnight gap down is, the higher you should wait for the stock to bounce in order to short. Both of the above tips are all based on technical analysis. However, please do not forget about the third key takeaway, the fundamental catalyst. Because technicals tell you when to enter, but fundamentals tell you the thesis and how hard to hit the stock. This gap trading strategy we just talked about, you will see this play out within the next couple of weeks, now that earnings season is approaching. So you best be prepared to trade all of these overnight gap ups and gap downs that we are about to see. If you want to learn more about technical analysis or trading earnings, make sure to check out this playlist to learn from my other free, beginner-friendly, and step-by-step day trading strategies. And don't forget to hit the like button and subscribe to see more educational videos like these. And of course, if you want to check out more of my day trading strategies, especially risk management, then make sure to check out the Humble Trader community down below. Thank you guys so much for watching as always. I'm the Humble Trader, and I'll see you guys next time.